Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features Mike Alkin of Sachem Cove Partners. Sachem is S-A-C-H-E-M. Cove is C-O-V-E. I first found Mike when he was doing a podcast I think I found him late 2018, early 2019. And he was laying out the uranium thesis. And he was doing, I don't know if it was weekly, it felt like weekly, but it was certainly regular. He was interviewing all the junior miners. He was talking to anybody that he could and laying his investment out in public. And I see the trade is getting a little bit more momentum. We just had the news from Microsoft and 3 Mile Island. And I always kind of said to myself, if I was going to do a uranium episode, I'd want to do it with Mike because he was the guy, along with this guy on Twitter, John Quakes, that were the two that were early and kind of helped me see what they were seeing. I didn't get deep enough to really see it, but I appreciated what Mike was doing by laying his work out in public and found it inspiring. So he followed me on Twitter and I was like, is this really Mike Alkin? He said, yes. I said, dude, I'd love to have you on the pod. He said, yes, this is the product. I hope you all enjoy it. As always, nothing in this program is financial advice. Everything is for entertainment purposes and education, not just entertainment. Entertainment and educational purposes. Please consult your financial advisor before making investment decisions and do your own due diligence. I hope you enjoy the episode. Before this music drops, I do want to give a shout out to my editing team at Speech Docs. You can find them on Twitter at Speech, and Docs is D-O-C-S. Dax and his team are fantastic. All I can say is that Dax and his team offer incredibly good value, and I very much appreciate what they do on the back end of this show. So if you are somebody who is thinking about starting a podcast, please consider Dax and his team at Speech Docs. That's S-P-E-E-C-H-D-O-C-S. All right, ladies and gentlemen, I am truly excited to be joined by Mike Alkin. Goes by Footnotes First on Twitter. And I would say that Mike put out one of the podcast products that had me the most interested in podcasting. And Mike, you can get into what it was like when you started, but you are the person that I associate the uranium idea with. I remember listening to you in 2019 talking about how you were going to industry conferences and there was no one in the room. You were interviewing CEOs on your podcast before it was a popular topic. And you and this guy, John Quakes, who I have never met in real life, but he is on Twitter. You're the two that, as the uranium trade is ripped, I have rooted for both of you to make money on it. And I hope that's what ended up happening because you deserve it.
Well, thank you. Thanks, Bill. It's great to be here. Yeah, feels like a long time ago. We started Sachem Cove Partners, which is the investment vehicle that we have to express the view in uranium. And that was back in 2018, I think it was. And back in 2016 and 17, I started studying nuclear power and uranium because the commodity was down 90% after Fukushima in March of 2011. So by 2016, the commodity came down 90%. The number of companies had declined by 90%. The equities were down by about that much. So it was very, very, those were hunting grounds where there was no one really there. And it's in markets like that where you can sometimes find an opinion or you can form a view that is different than consensus. And so that's what I was doing. Yeah, and to kind of share the view, I was doing a podcast and I was talking a lot about uranium, and there were not a lot of people doing it at the time.
There was no one doing it. Yeah. And I remember listening to you and thinking, like, this guy is all in on this idea in a positive way. And you were just talking about how in your career you had never seen something so asymmetric.
Yeah.
And just the idea of going into an area that there's absolutely no one, there was no interest at the time. Yeah. It was really fun to listen to you put that product out.
Well, thanks. It's hard as an investor. It's hard to find things where it's not properly priced in the market, but there are pockets of that, right? So you're trying to generate alpha. You're trying to a benchmark, if you will, and more often than not, quite more often than not, prices reflect what is. So the way I like to find things is look where others aren't, and that's what uranium presented at the time.
Did you go through a period where you had to ask yourself, am I the crazy person? Because
Absolutely.
I see opportunity here and no one is listening.
It's a really good question, Bill. So the hard part about looking at markets that are left for dead, people will use the term contrarian, is you are running into the fire, right? So right off the bat, you're probably going against consensus. But when you're trying to form a view, you start to do your own analysis. And that's one of the things that human psychology comes into play when you're looking at markets that have been so beaten up, is recency biases creep in and permeate all corners of the market. It could be the buyers, the sellers, the commentators, the forecasters. And when you come into a market without any of that baggage, but you understand the basics of how to analyze companies and industries and understand the drivers of supply and demand, there's somewhat of a playbook to doing that on both sides, both the supply and demand side. So when you come into a market at disadvantage, it could actually be an advantage. A disadvantage might be, I didn't know anything about nuclear power other than what the average observer might have known, and probably less. I certainly didn't know the uranium market. So I came in without any biases. And I came in and I said, let me just let the numbers and my conversations with people who understand this guide me. But to do that, I had to do the numbers, and I had to understand supply and demand. I didn't want to take an investment bank's model at first, because you need to understand where they are. But I said, let me build this from the bottoms up. Let me understand all the operating mines in the world and what the supply situation is, what the costs are. Let me understand the nuclear reactors, how many countries do it, what's the demand outlook. Because the narrative at the time was nuclear is dying and it's going away. And after Fukushima in March of 11, nobody wants it. And that's why these things are priced the way they are, the commodities and the service companies. But if you just take that at face value, you'll never find anything that might be a hidden gem, if you will, or hiding in plain sight. So coming to this market, I did that. I spent a good almost couple of years doing supply demand on my own. There's 430 reactors around the world, and understanding the country where they operate, the attitude towards nuclear, understanding the math involved, right? Often as investors, you look for heuristics. How many reactors are there? How many pounds per reactor would there be, right? You're looking for rules of thumb. And as you start peeling the onion back, I realized that rules of thumb don't apply here because the amount of uranium needed for the reactor fleet around the world is not always the same. It depends upon enrichment capacity. We won't go down that rabbit hole, but there's a whole other segment you need to learn. And so as I was doing that, and I would go to these conferences and I would talk to nuclear fuel buyers, people who buy this stuff. And it was hard for me at first to really understand what I was dealing with, because as somebody at that time having well over 20 years of experience as a hedge fund investor, it was very, I would talk to people in all industries that were on all sides of the equation, but the people buying it typically were curious as to what we were thinking as when we were questioning them. If we were talking to a buyer at a company that was buying a product, they would say, well, what are you as an investor hearing? What are you hearing from the other side? What are my competitors saying? What are you hearing about inventories? And they were inquisitive. That was not this cohort. As I started speaking to nuclear fuel buyers, I was met with an enormous wall put in front of me, telling me I'm an outsider, I'm not a nuclear engineer, I don't know what I'm doing, I should basically stay away, and they've got it. And I thought it was that attitude that just said to me, something's not right here, because the numbers I'm coming up with, whether I'm looking at inventories or the amount of the cost of the supply or the actual demand, and for context, at the time, the price of uranium was $17, $18, $19 a pound, and it was what it was trading for in the market. And as I did the analysis, I realized that the average cost was somewhere in the mid-50s. And I'm not that sharpest tool in the shed, but I know that if something costs you mid-50s to make, you can't sell it for 17 for very long. So it was then that I had to peel back the onion saying, well, why are they producing it at that price? And then you start to understand that there was the uranium market is one driven mostly by long-term contracts. Well north of 80% on average will trade in a long-term window with contracts that cover 5, 7, 10, 12, 15 years, depending on the contract. But that's where most of the pounds trade. So after the Fukushima event, a lot of these uranium producers, when the spot market had declined precipitously, were still selling into much higher prices. So my understanding of that, when I was talking to fuel buyers at these nuclear conferences, they were telling me that the price of uranium was 17 and 18, it was going to 10, it was going to 5. There was all this uranium out there. And that's not what my math was showing me. What my math was showing me was that the model was that the long-term contracts that had been signed before Fukushima melted down in 2011 were going to start to expire and rather rapidly. And uranium producers could not sell $17 uranium when it cost $18, $20 uranium when it cost them 2.5 times that at some point production would have to start to shut down. And so you ask, do you think you're crazy? Yes, because as I'm talking to people who are obviously very sharp, they're nuclear engineers, but it's understanding as you realize as an investor, you have to understand incentives and you have to understand market structure, right? And Charlie Munger would always say, show me the incentive, I'll show you the outcome. Well, it was as I was starting to go and talk to these folks and realizing a couple of things. Number one is they had no interest in what I was learning on my journey. And even though I'm not a nuclear engineer, I'm still somebody who's a market participant. And I'm still somebody that, while I don't speak their language, I certainly, sitting at a dinner table or a lunch table or at a bar having a beer with them, I certainly could hold my own in supply-demand conversation. And as I would talk about what I was learning and uncovering, I was shot down at every step. And I thought, wow, that's interesting because I'm seeing a recency bias. What is now will always be. And so they were kind of latched onto that. And as I started peeling that, why? I'm thinking, why is this? I've been doing this a very long time. And over the years, I've been wrong many times. I've been right more often than not. But you're wrong and you try and understand where you've been wrong. And I was thinking, what is it? Why are they so uninterested in hearing what an outsider's view is? And as I started to explore that more, you start to understand the makeup and the cost structure of a nuclear reactor, which I had known, but it really started to come into clear vision for me was the fuel. The uranium is just one part of the fuel cycle that goes in. You have uranium, they convert uranium from a powder into a gas. It then gets enriched. It then gets fabricated into pellets. That takes 18 to 24 months to do this stuff. So there's many different stages of the fuel cycle. And as I was starting to think about what is it, what are the costs of that? And the costs of that all those stages are probably around 20 to 25%. And then what's the cost of the uranium of that? And then that depends on the price, but it could be mid-single digits, high single digits, somewhere around that. And so it was then as you start talking to them about that, you realize it's not a meaningful cost. For comparative purposes, if I'm running a natural gas power plant or a coal power plant, my feedstock, the gas, natural gas, and the coal are 80 to 90% of the cost of operating it. Here, the uranium is single digits cost of operating it. So the vision that started to come to me was uninterested market participants. They're in the market very infrequently. Why are they uninterested? Because the cost is de minimis. Not to say it's meaningless, but it's de minimis. And then as I started to explore and ask questions at why are you not as concerned about this? I was obviously met with a wall, but what started to come to me was, and I asked flat out at a particular dinner at a World Nuclear Conferences, I asked one, actually there were 4 fuel buyers at a dinner. I said, if I were to If you all had a really enterprising fuel buyer that did the supply-demand work and said, you know what, I think consensus is wrong. Here we are, $17, $18, $20 a pound. We should be buying uranium because the forecasts going out into the future are for deficits to be forming. Let me ask you a question. Do you all, if the price were to go parabolic and you had all these great cost savings for your plant, do you participate that in any way, shape, or form? Are you rewarded financially? Are you rewarded with a promotion? The answer was, I got laughed at. What are you talking about? We're paid to secure fuel. So there is no, these were buyers. And as you come to a market as an investor, you think buyers are traders. They're commercial creatures. These aren't. These are really smart nuclear engineers that happen to buy a product that happens to not be a major cost component, that happens to be there's infrequent price discovery on their part. And so it's a lesson in understanding incentives and market structure. And as I started to do that, I kept being told how wrong I was by them. So back to your question, did I think I was crazy? Earlier in my career, I would have probably thought I was crazy. I was surprised. But I've learned over the years that narrative drive stories, but you can't outrun the numbers. You never want to build a model and stick your head in a model and just believe your model, because that's how you get run over, right? Garbage in, garbage out. But it could be garbage in, garbage out. But when I look back over my career where I've had bigger wins, it's always been driven by keeping it simple, keeping the math simple, understanding it, and knowing I know how to do basic math. That's what this is. It's not complicated. But understanding the narrative sometimes causes people not to even bother doing that.
Yeah.
Right? So people sometimes are a lot lazier than you might think they are. Everything, like I said, most things are kind of priced in. But when things are at extremes, too optimistic, when things can't get worse or things can't get better, it's somewhere in between. And people latch on to what is. And so I started to actually try and, what became more, was trying to figure out, get in their head as to what makes them realize that they're wrong. What is it that's going to cause them to have a moment? And the way I went about doing that was studying the past, right? Because it might not rhyme, it might not be exact, but it will rhyme. And especially in these deeply cyclical industries, human behavior is human behavior. And I realized in the last cycle and studying it, which was a big cycle, which was in the early to mid 2000s, where prices went from $7 to $137 for a pound of uranium, it was the same narrative. It was the same lackadaisical attitude. It was the same approach from the cohort that bought it. And because no one loses their job for paying a higher price, it just continued. And so one of the things that is hard for some institutional investors to do is to arbitrage the time. And here it was, it's always hard. Everyone said, what's the catalyst? What's the catalyst? Sometimes you don't know what the catalyst is. You just know that there's a mispricing. The price can't stay at $17, $18, $20. If it's cost in the mid 50s, it's got to get into the 70s, 80s at least at the time. That's pretty asymmetric. Could it go down a few dollars? Does it have to go a lot higher? Yeah. When? Not exactly sure. But somewhere within a time frame of a year, 2 years, 3 years, where prices need to start moving. And if I'm right, I'm going to annualize at a much greater clip than I could find a use of capital for other stuff. So that's kind of how I went about it. I was surprised I didn't think I was crazy. I actually knew I was onto something. The more of them I spoke to, the more obstinance I was met with, the more conviction I had.
I continue to bring up the podcast, but it was fun to listen to you on the podcast go through that because you were laying it out in real time. Right. And I remember you talking to some CEOs. I mean, you were talking to junior mining companies, you were talking to the big boys, but you were just like, the people are not listening and they're not seeing what I'm seeing.
Yeah. Bill, and there are people over the years now who I've Like the price of uranium sitting in the $80 range. If you're looking at a long-term contract that's market related today with floors and ceilings, a producer is going to sell to a utility with the price at $80, long-term price between 80 and 82, depending on which forecaster or price reporter. So say $81. A utility is going to pay probably $75 for a floor. Floor. So the producer, if you think about asymmetry today, long-term price $81. That's a contract that kicks in the fourth year and forward from today. The producer is going to get a minimum of 75, and the ceilings that the utilities want right now, those are anywhere from, depending on who the producer is and whatnot, you get 125 to 135. So if you think about that, how asymmetrical that is for a producer, it's quite a fascinating asymmetry, but today's investors will stare, even if fast forward all these years you're talking, they're still looking at the spot market. And so, in uranium, there's two markets. There's a spot and the long-term. And as I mentioned a few minutes ago, the long-term market is where, well north of 80% of pounds trade. And the spot market is a market where some producers might have a few pounds that are uncontracted for, and they might put it in there. Some are sold. Some producers have contracts with traders that they'll sell some pounds to on spot market pricing. But most of the pounds that trade there, more than half of them, so if 15 to 20% of the pounds in a given year trade in the spot market, half of those pounds are traders churning amongst themselves. Producers buy a little portion of the rest, and utilities buy a very small portion. And so utilities, the end user, is buying very, very, very little in the spot market. But the spot market is where at the end of each day is where a price is reported on it. So at 2:45 p.m., the price will come out, and investors will stare at the spot price. And it's such an opaque market. It's not an electronic market. You don't see how much volume traded. We actually buy physical uranium, so you get a sense for how much. Many days there's nothing traded. Think about that. It's a $6, $7, $8 billion physical market that nothing has traded on many days, and it could go like that for weeks. But yet the price might get reported a little. If the bid and the ask move around without a trade, the price can get reported. And at the end of the day, a price will be reported and people say, oh, look at the uranium price. And then they'll take that view and form a view of supply and demand in the market. They'll form that view of what's happening as a proxy for the uranium story and nuclear power story. And it's absolutely absurd. It's not that it's not an insignificant price, but if you're a trader, then it matters to you. If you're pricing long-term contracts, they're aware of what the spot price is, but long-term contracts, again, where the bulk of the pounds trade, are driven by the economic supply, the economics of supply and demand. How many economically viable pounds are there? So that price, the long-term price, is reported once a month. And so the vast majority of pounds trade in a market where there's very infrequent price discovery and a lot of opaqueness. And so where do investors turn their attention and choose to focus their time and energy? On the market where value is not really created, the spot market. Why? Because it gives them a barometer, right? And we talked about investors, opaque markets, why you can find an advantage is it's not easy. If it's hard, less people are inclined to really go down and dig deep. And so they will follow a price that is not as important as what creates value for these producers of uranium. So it's understanding market structure, and it's understanding that, and it's, again, you go back to your crazy point, when you are looking at markets like this, you just have to have the conviction, if you've done the work, that yes, you can be right. And when you're asking yourself if you're crazy, which you have to do every day, in my case, it was just relying upon my conversations with people, a little bit of experience, and understanding that usually you can't outrun good math.
Yeah, I mean, so when did you decide to really go all in on the idea? I mean, Were
Yeah.
you 6 months into the research process? Like, what was it? Because
Um,
if I'm
yeah.
remembering correctly, I mean, you really leaned in, and it was a career pivot for you. I mean, not a pivot in that you were always an investor, but you were
Yeah.
like, this is the idea.
Yeah, yeah. Versus going from saying a generalist, more focused on cyclical industries, but to this is the industry.
Yeah.
Um, that was late 17, early 18.
Hmm.
And in 16, it was a journey, right? It was, hey, I don't know this market at all. I couldn't tell you the first thing about nuclear power. But so I came at it when anything's down, like I said in the beginning, 90% like that, it's worth a look. But I came at it. My first 10 years of my career, I was mostly a short seller. I was looking at looking for companies that were economically broken or had some bad characters. So I was looking and doing that, you're doing stuff away from consensus, right? You're doing your own research, and you have to be aware of consensus and understand how it squares versus consensus. But you have to have the courage of your conviction, and you have to sometimes make a bet. And not sometimes, but you're making bets that are against mostly consensus. Things are more often than not want to go up. So it was once I started so I came in as a short seller. If I could prove the bear case, and the bear case that I could find was nuclear's dying, it's too expensive, it takes too long to build, renewables are coming, wind and solar will eat their lunch, and that's pretty much it. And I said, okay, let me do that. And it was very quickly that I went down the wind and solar, and I hadn't known that too much other than what everyone else was reading. And as I did that, I realized you can't replace a baseload energy source with an intermittent energy source. That's not how energy transitions have occurred. And I read a lot of stuff by Vaclav Slim, who writes great stuff on the energy market. And
Smeal, right?
did I say Slim? Smeal?
Yeah.
Smeal.
Yeah.
Sorry. But I read a lot of his stuff early on, and you just realized pretty easily that energy transitions occur over time, long periods of time, not in a time frame that investors or Wall Street wants them to, or the City of London wants them to. And that's what I was getting the sense here. And it was not easy to prove the bull case for wind and solar, nor was it easy to prove the bear case. And so as I started, my first quest was demand was, okay, how many countries produce nuclear power? 30 at the time. I needed to understand the attitude of each of those countries towards nuclear. Was it negative? Was it neutral? Was it positive? And then by just going to the World Nuclear Association and downloading databases of reactors around the world, you start to put them on a spreadsheet. You start to understand the size they are, how much output there is, and the country's attitude. And I went draconian, and I said, okay, if a country's neutral, let's assume they're going to want to start closing reactors, some of them. And as I did that, and it took quite a while, several months, I realized that even with the draconian approach, there was still growth in nuclear power. It wasn't dying. And it was at the time 11, 12% of the global electricity grid. That's a big chunk. And realizing that I get it, people want wind and solar, but just because you want it doesn't mean it's going to happen. And what I also realized was that's great. When the wind's not blowing, the sun's not shining, you need something else. So how's that going to work for the CO2 emissions when you were going to have natural gas or coal-fired backup? And I started to realize that there might be some lengths, because the case at the time was nuclear was dead, and it wasn't dead. So as long as there was a growth side of it, and then that's when I started looking at every mine in the world, every prospective project of the world, and realizing where the costs were and how far disconnected they were. And so as I started to do that, that's throughout 2016, and then in 2017, you started to see some production cuts started to come in. And I was going to nuclear conferences at the time. And I had just had enough confidence after doing supply demand and studying the inventories that I could now have conversations with people who buy this stuff. And and I was okay to say, hey, look, I'm new, go introduce myself, walk up to them. And I'm really new at this. I'm probably going to ask some really stupid questions, but if I could get a few minutes of your time, yes. And I met someone who was at the state-owned producer, Kazakhstan, who was kind enough to invite me to a dinner one evening with a number of fuel buyers. And it was those conversations with the people buying it where I said, I need to do this because my math might be I'm still learning some of the stuff, but I think I've got the supply demand situated. And as I was starting to look at it, I said, it's not dying. We've got a little bit of growth. The prices need to move materially higher. And the sell side had disappeared, right? Most of the banks who were writing research on this fired their uranium analyst, or they transitioned them to covering something else. And I was like, this is really an abandoned industry. But it's an abandoned industry that's 11, 12% of the global electricity grid. How is that possible? But it was. And then it was during these conversations in early and mid 17 where I said, I'm right here. Like, this is asymmetrical risk reward. And I wrote a research piece for myself. And I started circulating it amongst some of the people I have a great deal of respect for, who I worked for in the hedge fund business and who I was friends with. And I said, when you have some time, take a look at this and tell me where I'm wrong. And some people I really respect. And they came back to me and they said, wow, nothing about uranium. This is really interesting. And they had a host of questions. And I started tracking down questions and looking for answers. And that was late 17. And a few folks came back and said, have you thought about starting a vehicle? Because this makes sense. And if you wanted to express your view, I would express my view alongside of you. And I had considered it. I've had times in my career where you just say, I have to do this. You have to make a big bet. And that was this, where I could not look around the other part of any market and say, I could see this type of asymmetry. And that's when I decided to express the view doing that. And you're putting it on the line there, right? Because you're either right or you're wrong. But that's the beauty of it. The market will tell you eventually. And so that was it. And I don't know how many of those you see in a career lifetime where you feel as though you just look and say, wow. And you have to be careful, right? Because still every day, Bill, I come in assuming I'm wrong. I come in every day assuming there's someone smarter than me out there doing this. I assume every day there's someone that's found some piece of information that I was unaware of. But you also have to, you also, as in the uranium investment, as it's grown and as the price has gone from 17, 18 up to the 80s, at one point it hit 100 very briefly. But as that's in the spot market, in the term market, it continuously grows. It's up 20% this year, the term price, while spot has backed off a bit. But again, the price I'm focused on is the term price. But then as it becomes more populous, you start to get a broadening investor base that comes into it. As that happens, you bring people into it who are bringing their own approach to investing into it. And you've seen a lot of the bigger hedge funds. Some hedge funds are starting to come into it, and you can't will your way to a thesis. To truly understand it, I think you have to lay out the numbers yourself and do them and understand enrichment math. I've spoken with some folks, and they do very rule of thumb math on reactors, and that's a sure way to get your head handed to you in this business from a financial perspective, because rules of thumb in this, you got to be more exact than that. So it's a fascinating sector. And again, it's one where it's still, even though it has become a bit more popular, it's still a very small industry. It's still as opaque as it was as the day that I started. And what people don't see, and you mentioned footnotes first, I've gone dark since probably 2019.
Well, I was looking for you, and I was like, he's gone. And then when you came on, I was like, is this really you?
I still have it, but I just kind of went dark because we're so again, we have consensus numbers that are from industry forecasters, and we're clients of them. And we've really, over the years, taken issue with industry forecasts. And what I don't do publicly but we do privately is we advocate for our view with the industry forecasters that here's why we think we're right. And think about the IEA, right? How they're always changing their numbers. All these quasi-government agencies, they're not economic creatures, and they're not commercial creatures. And so we do a lot of quiet, behind the scenes activism, if you will, in that regard. And a lot of what I would see on Twitter is just conversations that I'm going to wind up resorting to. Hey, let's look at the math, and I'm not going to share our math with people. So I just decided to back off there.
Well, I mean, that makes sense. In your position in this particular thesis, you basically become the source and then you're giving away all your IP. It doesn't make sense.
That's a fair point. Yep. Yep. Agree.
But when you were starting, it was, like I said, it's cool to see somebody that put it all out there in real time. And I kind of see the thesis floating around now. And I just always go back to your early stuff because I'm like, that's the guy that I'm rooting for in this entire trade because he put it all on the line. And it's fun, man. It's cool to watch. Are you as comfortable now that it's got some attention on it, or do you find yourself the kind of investor that is more comfortable when things are more hated?
That's a great question. Fantastic question. First of all, so I see a lot of the bigger funds will come in. And what's amazing is I've been in the hedge fund business a long time. I worked at a couple of really big hedge funds. I was a partner at one for almost a decade. Yet I will see some bigger name hedge funds in the trade and never receive a phone call. I get phone calls from investors, from hedge fund guys or from mutual fund guys who want to ask questions. But then you see some bigger firms come in. And so I get a fair amount of inflow, but I'll see a lot of stuff that you would think that if there's only a few people that do this, you might get a phone call to say, hey, you want to kick it around? And that doesn't happen all the time. So it doesn't happen a lot at all. And so there are idea dinners, as investment banks will hold idea dinners. I might send one of my guys, or I will very rarely, occasionally I'll go, but not all the time. But in the last year, you've seen a more accelerated pace of bigger funds coming in. And they have theses that they are convinced is going to drive it. And then it all always reverts back to what's spot pricing doing. And I'm not going to engage in that.
Yeah, well, that's nice to see, though, because you can say to yourself, well, people still aren't even asking the right questions.
Absolutely. But I do see, so for instance, in periods when everyone's piling in and they want to buy it, I'm like, if it's for the right reason, yes. But if it's because, they think spot's going to have a huge move, like this year is a great example. Spot is down, I don't know, high singles, low teens. Term pricing, that's where the magic is made, is up 21, 22%. And why? Because that's telling you that utilities have not contracted at the pace they did last year, meaningfully below, and on a lower volume, their prices are still higher. And that's kind of like perfect, right? It's because if volumes are down, then normally pricing is down. Here, volumes are down and pricing's up because there's really very little economically viable pounds. And so that will sort itself out over time. But, you got, for instance, what we're seeing now is with data centers and AI. And just on Friday, Microsoft announced a fabulous deal. They're with Constellation. They're bringing back 3 Mile Island. Think about that. Microsoft signed a 20-year power purchase agreement with Constellation to bring back of all reactors, 3 Mile Island, right? So why? Because they need the energy for their data centers. So this is a huge deal for both that puts the good housekeeping seal of approval on it. It's the second deal from a major tech company, but it's great for nuclear. And earlier in the year, you saw a deal much earlier in the year, and that kind of drove a lot of investor interest. And understanding the role of AI and data centers in nuclear power and uranium is important. It is fabulous for nuclear power plants. It is fabulous because it gives them, it validates how important clean energy is. It validates how important reliable baseload energy is. And the dollars from this are fantastic for the nuclear power plant. And I think it creates a great reason to build new reactors, but also you're seeing plants that were closed come back. Palisades, Michigan, this one coming back. That was in nobody's uranium forecast. So those are great. But you have to understand the context of that. That's over time. Right? So over time, reactors will get built. Over time, these plants will come back online. The physical spot trader of uranium right? There are 7 or 8 traders of physical uranium with not a lot of balance sheet capability. Not that they're small entities, but the uranium trading side of it doesn't have significant balance sheets. They see an announcement. They're not going to run out today and buy uranium for that announcement because a plant is coming back online in 3 years. That's just not how it works. It's wonderful for the overall nuclear theme. It's wonderful for all the future uranium needs. And it is great for all of that. But if people pile in thinking that it's going to immediately go parabolic tomorrow, they have to understand the context, right? And again, they're focusing on spot, where you'll see that really manifest itself is in long-term pricing, because the utilities will want to go out and secure for these plants. So it's just, as I see people come in, and if I see the narrative, their narrative, right? I have to be aware of their narrative. I have to respect their narrative. I have to respect their viewpoint, and it informs how I'm positioned. Ultimately, all this stuff is great for it, but you just have to understand who the participants are and what their expectations are of it. And in such an opaque industry, I can't tell you how many times I've spoken with really sophisticated investors that I talk about the difference between spot and term, and then all of a sudden, spot will have a few days down and they're calling up saying, "What's wrong? What are we missing?" You're not missing anything. That's not where the value is created.
Yeah,
So,
you're missing that it doesn't matter.
yeah, you're missing that. It's, but you realize that people really need something to look at every day, right? Just taking, and again, I think a lot of it goes back to, a lot of investors like to take shortcuts, and I get it. They're looking at many different industries. They're doing different things. They use heuristics. So I think that's where the opportunity is created. Sometimes it creates some short-term noise. You just had to pull back in the uranium equities. In the last few days, they've been ripping, but you saw people piling into it on AI and data centers in the spring, and all of a sudden uranium, the term price was going higher, but the spot price was going down a little bit. And people were saying, wait a second, how is that? What's happening? Why isn't the term price, why isn't the spot price going up? You're like, oh my God. What do you, like, okay. So that kind of informs how I want to be positioned, as in terms of, do I want to be fully invested at any time? Do I want to have a little bit more cash around, that type of stuff?
Yeah. So back, what, 6 years ago or so, you weren't having those kind of conversations, but now positioning might matter a little bit more.
Exactly. And then you get to the point where you just kind of rip the Band-Aid off and just say, you know what? I'm ripping the Band-Aid off because the fundamentals are so good that I'm willing to withstand some more volatility. And in my head, we're kind of at the rip the Band-Aid off stage, where, yeah, I know you're going to take, sometimes you're going to see some volatility down because maybe the spot price moves down $1 or $2, whatever it be, a few bucks, who knows, or it goes up a few bucks. But in the stuff that I'm more and more honed in on, you feel really good about it. Those are the times where you just say, that's it. And eventually the others will catch up to it. But yeah, we were talking about 6 years ago, the risk from the Russians. I mean, I remember giving a presentation at a conference, I think it was in Vancouver, it might have been in 2017, talking about the geopolitical risk. And one of the things that I couldn't understand as a layperson coming into this is, how is it, am I missing something? Or between the Russians, the Kazakhs, and the Uzbeks, they said the Americans buy half their uranium from them. And nuclear power is 20% of the U.S. electric grid. Like, again, I know I'm not a geopolitical expert at all. I know probably just what the average person does about it. Now I pay more attention to it the last several years because it's what I've needed to do, but I'm certainly no expert. But really, like, you're a U.S. fuel buyer and you feel in a Western or Western European fuel buyer, and you really actually think that works? You think that if you're a U.S. nuclear power plant and you look back and say in 1981 and 82, the industry used 50 million pounds of uranium for its nuclear power fleet, and it bought 44 million pounds from American uranium producers. And fast forward to 2017, and today you use roughly 50 million pounds of uranium, and you buy, and the U.S. produces a few 100,000 pounds. Like, you think that's normal? That's just not normal. That's not good. At some point, you run risk of something happening. And at the time in my 17 presentation, I called it, the U.S. is playing checkers while Putin's playing chess in terms of nuclear power and uranium security. And so Russia controls 40% of the global enrichment market, 30% of the conversion market, 15% of the uranium market. These are all part of the fuel cycle. So just looking at that, at how lackadaisical the U.S. fuel buyers are, I could say, and not every one of them, but way more of them than not. So at the time, I felt those were important points to bring up, and people just yawned at it. And even today, the fuel buyers, I'll see them at a conference, maybe I'll chat with them, but I've been there, done that. And they've been telling me I'm dead wrong since 2017. I went to the Nuclear Energy Institute, which is the largest trade body in the world, besides the World Nuclear Association. But in the U.S., it represents the interests of those in the nuclear industry. It read the utilities, and they represent them in Congress, and they go lobby for them. And back in 2018, we went to them and said, the forecasts that are out there from industry forecasters, we think are not only wrong, but they're materially wrong. And they're driving, looking in the rearview mirror. And they said, okay, go take a walk. We don't know you. And we kept at it, and I kept going to them, and finally found someone there that was very willing to listen to us. And we said, look, here's our math, and here's a deck, and here's our math, and it's not our own forecast. This is our analysis of the forecasts that are made, and this is why they don't make sense. And again, we're not nuclear experts, and I was very grateful to have somebody there take the time to listen. And they said, okay, well, come speak at our annual conference. You can speak to the fuel buyers. And we did in 2018. And that was, I think, fall of 2018. And I stood up there and said, you folks have done a wonderful job. You were not signing long-term contracts after Fukushima. The price of uranium was in the 70s, and then it's down in here in the high teens, low 20s. Congratulations, you didn't re-up on long-term deals. You sucked some pounds out of the spot market. That's when spot matters, when there was excess supply, which there's not now. I said, so you guys have done a good job over the years. And you're looking at industry forecasts that would suggest to you that you can still stay out of the contract market for a long time. And let me just share with you a viewpoint as to why that's different. And the numbers I'm going to present to you are not our numbers of our outlook on the future. It's uranium math and nuclear math as you guys know it, and why it just seems like it's illogical. And we did that. And I stood up there for, 35, 40 minutes, and I came off the stage, and someone approached me and said, how dare you come here? And I said, I'm sorry. They said, you're just some bad Wall Street person who only cares about money, and these are good, hardworking people. Like, what is wrong with you? And I said, like, are you serious? Like, what are you, out of your mind? Like, who are you? And so I said, you have a minute? And she said, why? I said, well, come over here. Let us show you. I was with Tim Chilleri, who works with me. And I said, let us show you like how we come to these conclusions. Let us show you what a model looks like. And it's, it's enormous, our model. And again, you don't want to get lost in your model, but that's how we drew our conclusions. And not long into showing this person, she said, wow, I had no idea. I thought you were just some bad Wall Street guy. I'm like, well, I don't even know what that means, but okay. And so prices moved up a little bit throughout 2018, and we kept coming back to the NEI saying prices, these forecasts aren't changing, and they need to. And they said, present again. And I did that in Nashville in 2019 in the fall. And I was met with the same disdain. Fuel buyers would come up to me and say, you have no idea what you're talking about. I could buy all the uranium I want. Prices are going to 15 and 10. I had one of them taunt me by saying things. It was really like again, not all, they're not all like this, but I was really, really surprised and taken aback by the lack of intellectual curiosity about someone else's view from people who are really bright. And so that, I can't tell you how much conviction that has given me. And one of the things you see now is you have expert networks who provide hedge funds and mutual funds, experts to speak to in any industry. And so if you're a hedge fund wanting to get up to speed right now on the nuclear power industry, you're going to say, hey, go get me 3 nuclear fuel buyers. I'd like to speak to them about uranium. And they're going to get on the phone and they're going to speak to them. And for years, though, I'm sure they've been doing this. They're going to get on the phone and speak to 3 fuel buyers and going to say, yeah, there's plenty of uranium out there. And those are the same folks when the price was 17 was telling me that. And versus here, you're seeing floors and ceilings at 125 and 135. They are the gift that keep on giving. Yet the way the structure of the research process is, they're going to expert networks, they find these people, and if you don't understand and how the sausage is made, you're going to be misled. They're not purposely misleading you, it's just what their own beliefs are. And so it's for me, that's a beautiful thing. But I've been doing this a long time now, about almost 30 years as a professional investor, and I've never seen a cohort of people who are so uninterested in hearing the other side of the story. And so far, I've seen them prices move up 4x in there against them, and they still have the same attitude. Which,
well, to your point, it doesn't sound like they're very incentivized to care.
There's no incentive to, very little to none incentive to care, other than maybe you would think pride. I don't know, but it doesn't matter. It's just not a thing. But we actually chuckle because if we go to, but when we go to these conferences, I mean, you talk to them in a hallway or in a bar, it's as though you're an adversary. It's very bizarre. They don't have an incentive. It doesn't matter what they pay. So that's the bizarre thing, is they should want to hear. What do they care? But they don't. I don't know that I'll ever see anything like this in my career again. And you get so few, well, I hate to quote Buffett stuff because it is what it is, but if you had a punch card, how many times would you punch that card in your lifetime in investing? I don't know where I'll see anything as asymmetric as this because of the information asymmetry and the inner working. I said, I don't know when, but it's an MBA class in inefficient markets is what this is. The whole uranium trade is an MBA class in how to find value where others aren't looking. And then layer on the whole other aspect of why market structure and market incentives are so critical to understand.
When you say that you don't know if you'll find anything as asymmetric, are you still thinking it's that asymmetric, or are you thinking about when you first stumbled into it?
That's a really good question. When I started this, I would have thought you get uranium prices up into the, 70s somewhere, and you kind of call it a day. Because in our modeling, I never really put much growth in there. What I never anticipated was the demand that we're seeing now. When you were listening to those podcasts I was doing in 2019 and 2018, when we really started out on this, the attitude from the major nuclear power producers in the world was negative. So the United States, the largest, it's 20% of the electricity grid in the U.S. At one point, it was almost 30% of global nuclear power. Reactors were closing. Half the markets are in competitive markets, and it was challenging for them, fighting heavily subsidized wind and solar. So and the outlook was more negative than positive. South Korea, you had just had a new president come in who ordered all reactors under construction to stop, and they wanted to reduce the reactors, and they're a major producer. The French, who derive 75% of their electricity from nuclear power, in 2018, 2019 had said they were going to go down to 50%. So they were going to reduce their dependency on nuclear. The Japanese were still reeling from the Fukushima after effects, and there were 54 reactors at the time in March of 11. When Fukushima went down, they shut them all down, and they started importing LNG. But at the time, nuclear was 30% of their electricity grid. So at that time, we just thought they only had a couple running. You thought maybe they might not bring any back. The UK had the same attitude. It was permeating. So, and I even went draconian on that. Fast forward to today, the French are not only not going to go to from 75 to 50, but they're going to build like 14 new reactors, monster reactors, which is enormous. The U.S. is seeing life extensions. The U.S. is seeing closed reactors restart. They've got production tax credits. They're getting these deals with the major tech companies like Amazon and Microsoft. It's enormous. The Koreans are back to building reactors. The Russians are building a lot of reactors. That's not, again, it's Russia, but that's going to take Eastern pounds and send them east. just the UK, everywhere you look, there is a rejuvenation of nuclear interest and demand. And, it's not what was basically no demand to barely any, maybe not even 1%, is now 4 times that amount. And then you've got, which we don't even include, is the small modular reactor demand. You've got secondary demand, which is one of the things that we didn't touch on, but this industry, as I mentioned, was driven by long-term contracts. In periods of excess supply, like occurred after Fukushima, when 54 reactors went off the grid, you had a backup. The utilities would only contract at about 33, 35, 37% of their annual needs. So they would burn fuel in a reactor and then only contract for a third of that, roughly. And they did that last cycle, too. And they did that last cycle from like 92 to 04. They burned 34, 35%. And then all of a sudden, when they decided to go back into the market, again, because they were complacent, and again, because it's just how they operate, they go to extremes, and they wound up purchasing some years 120, 130% and more of annual requirements. And so when you look at that here, you fast forward to since Fukushima through 2022, what were they doing? They were buying about 36 to 37% of their annual demand, replacing it with contracts. Again, they've undercontracted, so there's going to be secondary demand. So we look at this new demand coming from all of these major countries that heretofore had been turning negative are now doing a 180. You've got SMR demand coming. You've got extensions coming. You've got uprates, which a lot of people don't talk about, where the nuclear power plant will increase the productivity. They spend money to increase the output of the plant. Mm-hmm. And that can be very meaningful. That is not in people's numbers. And so when we look at that demand profile now, the thing we haven't seen, because the utilities have been so slow to react to cover all of their future uranium needs. And Bill, if you think about any mining, to build a copper mine, to build any mine, it could take decades from discovery, from exploration to discovery to permitting, the licensing, the building and financing and all that stuff. And uranium is no different. Uranium mines take decades in many cases. And so in mining world, 7 years, 5 years is tomorrow. And so in the case of uranium, when you look just out to 2030, we could look to 2040, 2050, who knows, right? A lot can happen in there. But you just look out 6, 7 years from now, depending on a few different variables, but anywhere from 20 to 25% of the supply that is needed for the demand in that year, 2030, doesn't yet exist in the form of a mine. So there are identified projects. They're going through the licensing and permitting phase, but they're not mines. And building them, stuff happens all the time. And so when you look at that, it's very, very significant as to what's out there that needs to be built. Another 5 to 8% can come from existing projects that are on care and maintenance. So you've not, because the utilities were still disbelieving. They haven't committed enough long-term pounds under contract. If we did go 2040, it's a number that's in my head. I think the number is about 2.2 to 2.4 billion pounds. And again, roughly by our math, 210, 20, 30 million pounds per year of consumption. But there's over 2 billion pounds that's not contracted for. So those are called uncovered requirements. So the utilities are facing a significant delivery waterfall expiry. So all the old contracts they signed are starting to fall off a cliff right now into a period where they need to start contracting for a demand profile they as a cohort globally did not anticipate. Normally, in these cycles, you don't see demand moving that much. So they may have been slow in the last cycle. In the last cycle, they were contracting at 34, 35% from 92 to 04, and then they went up to 110, 20, 30% of annual needs, and they contracted for because inventories were down. But that demand profile then was not gangbusters. It was low single digits. Now, all of a sudden, they've had the same complacency, except in the last cycle, by the way, I should add, when the contracting started in mass in '05, when you looked out to the future over a 6-year period, there was a couple of £100 million of surplus in the market. And when they started contracting, prices went parabolic. Fast forward to today, even by the industry forecasters who we vehemently disagree with and think they're dramatically understating the real supply-demand numbers just because their own analytics, not for any other purpose, they show deficits. And so when we look at, you asked, even after the price move, do I still feel? I feel the asymmetry is as good, if not better, likely better, because the demand side of the equation has moved up so much. And once these things get in motion, they stay in motion. Once things are in construction, they stay in construction. So yeah, it feels good. Now that doesn't mean that with it though, like I said, brings more interest, brings more people who bring their own investing playbook to it. And when they're coming in and you've got big funds coming in with large amounts of capital and they think they're looking at copper or gold. And again, remember, a lot of at least Western U.S., I'll say, investors, they don't look at commodities almost ever, right? But now they see this commodity is working and they're coming into it, and they look at it like they treat it like their tech data, like their data points looking at a tech company. And, we hear what's important to them and we just think that, that's not the play. And so there will be some increased volatility with it. But when I look at the amount of uncovered requirements, those that are not contracted for, I look at the precarious nature of mine supply. Here's another point, Bill, is 65% of all pounds of uranium produced are produced in the East, and almost 70% of pounds consumed are consumed in the West. And in that, one of the things that the people have brought with their assumptions is that Kazakhstan, they produce 41% of global uranium, and they're 20% owned by the public, and that was floated in 2019. The rest is owned by the state, by the Sovereign Wealth Fund. And everyone assumes that Kazatomprom, which is the name of the company, when they came public, their cost to produce a pound of uranium was something like $14 per pound on an all-in sustaining cost basis. So cash cost plus other expenses to run the company and other items, about $14 a pound. And you recall I said earlier, the average cost to produce is in the mid-50s. So the prevailing wisdom would be, well, the Kazakhs are the low-cost producer. They could just pound supply into the market. And they're the largest producer, and they're just a spigot that's always going to get turned on. And those are what all the real sharp folks who go to idea dinners will talk about. We hear that all the time. And I tell those sharp folks they should go back and sharpen their pencils a little bit. Because if you actually did the work on Kazatomprom, what you would see is that the state-owned producer in Kazakhstan does produce a lot of uranium. They also cost in tenge and they sell in dollars. And so in around 2012, 2013 time period, the tenge was in the 75 to 85 tenge to the dollar range. They devalued the currency and let it float against the dollar. And so if you were to look back then, before the company was public, they had debt. And so they did have annual reports. And if you were studying like we did in 16 and 17, went back and found those, one of the things we noticed is, wow, they weren't producing in the mid-teens. They were producing in the high 20s and mid-30s. And then all of a sudden, as you start to get to the devaluation and the tenge goes from 75 to 80 tenge to 340 tenge, all of a sudden you start to realize that, hey, wait a second, this is really an FX play to an extent. Yes, they produce.
Interesting.
Yes, they produce a lot of uranium. So now you fast forward to that could they produce? Yeah, well, in 2017, they were the first to cut production. And they said, well, we're cutting production. We don't like the prices. And we're taking a value over volume strategy, which would be a departure from Eastern philosophy, right? The Russians just pounded out there. And so that was a departure. So they were disciplined in 18 and 19. And in Kazakhstan, they produce under what's called subsoil use agreements. Those are agreements between the entity, the miner, and the state as to how much you can produce. And you can produce plus or minus those agreed upon numbers, 20%. And if you go on either side of that, you have to go back to the state and ask for approval. So in 2017, they cut production 20%, 2018, 20%, 2019, 20%, then COVID came along and it's been 20% below. And everyone keeps saying, well, they're going to turn the spigots on. They're going to turn the spigots on. And when they do, here comes a flood of uranium. And our view has been actually, actually, the Kazakh uranium is challenged. It's a vast reserve. There's significant reserves. A lot of it was mined. They came out of nowhere in 2000. In 2005, if you looked forward, in 2015, they were supposed to go from 9 million pounds of production to 21 million pounds. By the time you got to 2015, they were producing 56 million pounds. That's in the ballpark of what they produce today. And a lot of, as most miners do, they take the good stuff first, right? And they leave the harder stuff behind. But as we've gone forward, the reason you see a lot of this discipline, they have a hard time getting supply. They have getting acid to do it. They're having a host of issues, not to mention that Russia is in their backyard and puts pressure on them as to where supply is going to go. But when they just recently gave guidance for 2025, production is down 17% versus the subsoil use agreement. And people thought that would start to get closer. But what you really see is the cost to produce a pound of uranium is now going to be guided to $28 a pound. So when they came public, their costs were mid-teens, and if you looked at what they were projecting out by 2024, 2025, they were low teens. Well, they're not low teens. They're guiding to $28 a pound. And if you currency adjust, because the tenge has gone from 340 when they came public in 2019 to 480 now, it's really like $38 a pound. And so rule of thumb, heuristic, investor, institutional investor, well, the Kazakhs are a state-owned producer, largest in the world. They're just going to keep sending low-cost pounds. Reality of those pounds are 2.5 times what they thought they would cost. It's more expensive to produce. They're not producing as much. And with these geopolitical wins, you're seeing a lot of, without getting into great detail, you're seeing a lot of the influence, the Russian influence in Kazakhstan move those pounds very likely to head east, not west. And the West and some of the Western utilities need it. So that's another factor that's out there that's hanging over the market. And I'm not sure that as odd as it may sound, I'm not sure that's fully appreciated.
That's interesting. I mean, when I think back to what you were talking about, when you've got the potential, I guess the narrative in the market was the overhang from Russia using some of their nukes to what, unenrich, de-enrich? I don't know what it is, but they were basically like using surplus uranium from the nukes.
Yep.
And there was just a lot of, I mean, when I thought about it, I just said this would like require truly dedicating my life to getting through the opacity here.
Well, so they did,
and it sounds like it's true. It remains true.
Yeah, it's a good point. The opacity is still there. As to that nukes thing, that's called a megatons to megawatts. And from after the wall fell in Berlin and Russia and USSR went away, the U.S. was concerned that a lot of those nuclear warheads would wind up in bad actors' hands. So they had an agreement from 93 to 2013 to downblend a number, 1,600 nuclear reactors, and take the highly enriched uranium, which is in a nuclear warhead, and downblend it to low enriched, which is what you use for reactors. One is 90% for bombs, and the other is 3 to 5% for reactors. And take that, and it's a very expensive and complicated process to downblend it, and then you could use it. And that was a way the Americans could pay the Russians to not be to not sell it to bad actors. And that existed, and that created an additional 20 million pounds of supply into the market. Now, again, for context, at that time, during that time period, you were probably looking at 170 million pounds of demand. And in the U.S., it was 50. So the U.S.
That's a lot of incremental pounds.
Exactly. And that's gone away now. And the opportunity might exist down the road for some warheads to be used for these new advanced reactors. If there's a shortage of low enriched capacity, they might be able to use it, but you're talking a minuscule amount, which would be wanted for the SMRs, which is a mid-2030s type thing down the road. So that that's a good thing from the potential for available demand, although it probably would very unlikely happen because you can't, it would be the availability. Could it be out there? Yeah. Could it help advance SMRs? It might be able to. We don't factor that in. It could. That would be a good thing. But yeah, so there was a lot of the SMRs use, I should say the SMRs use high assay enriched uranium. So it's a 20% enrichment level versus the 3 to 4% enrichment level. So you don't have to downblend it as much. But the SMR.
How long does an SMR take to get sort of from conception to implementation?
Conception, a long time, decade, a while. But in terms of the features to an SMR, and I am not an expert on SMRs, but the big reactors in the West, big reactors have been a problem because they're customized. Every reactor is, even though it's a model, it's built on site. And so there's variability in the construction and delays and cost overruns.
It was the last big one in Georgia.
Yeah, exactly.
Yeah, and that thing was a mess, right, from an overrun standpoint.
Yeah, for years and years and years, and immense amount of billions overruns.
Yeah,
because each one is custom. Well, the SMRs are built in a factory, and so it makes it standardized, and you could have standardized supply chains. So,
oh, interesting.
Yeah, so that is in the future, though. We put even though you could have that demand in our modeling, we put very, very, very little demand for it. So
the reason I find it intriguing, and this is obviously no longer like a secret because of what Microsoft just announced, but I have been racking my brain to figure out how we can have the forecasted energy demand usage of AI,
Yep.
and also pursue a green solution to energy.
Yep.
And the only answer in my head has been nuclear, because I just don't, unless I guess battery storage just gets so much better, but it just doesn't seem possible to me.
Exactly. Nuclear is a very elegant, existing, simple, it sounds odd, but it's a simple solution, right? It's, when you look at it from a safety standpoint per terawatt hour, it's the safest in the world.
Well, you know what's wild, Mike, is the reaction to Fukushima. And I mean, unless my research is wrong, which it's very possible, but I don't think that there was maybe like 1 or 2 direct deaths.
Yes.
Attributable to the health consequences. And like, didn't one person just recently die? But like,
Yes.
the deaths were all related to the earthquake and the tsunami, which was a tragedy.
Correct.
But that's not a nuclear reactor issue. That's a nature issue.
Exactly. Yes, that's exactly right. And I don't want to trivialize the deaths of the people at the plant. That's terrible for them. But yeah, so when you look at it over the data over decades now, it is a very safe form of electricity generation. And I think the Microsoft deal of, like I said earlier in the beginning, of all reactors, right? 3 Mile Island, which has this stigma attached to it, that was operator error. And here they are bringing the plant back online. So it's really a nice ringing endorsement from a major tech company.
I'll tell you, as a person who roots for capitalism, it was pretty nice to see that headline too, because there would be a beautiful thing about the biggest tech companies in America solving the green energy crisis through capitalism. That is an outcome I root for.
Well, so that's a great point. One of the things that I've noticed such a great point with the fuel buyers is always waiting for the government to come in one way, shape, or another. Always hoping for all different facets versus letting the market solve it. And here, to your point, you're seeing the market solve like this with Amazon at the Susquehanna, and this with Microsoft 3 Mile Island. I mean, the Constellation stock was up 20% on the news Friday. The markets are telling them it's okay. Go out and build more reactors. Go out and these are good things to happen. And so it's funny how the free market can solve for a lot of things. It will be interesting to see, because that's not how fuel buyers think.
Yeah, I don't know that it's how the people in our government want to think either, and that's why I'm really rooting for it to be a real not bottom up solution, and it would be right. I'm rooting for it. It would be awesome.
Yep.
So we'll see. Have you changed your views on the incremental power generation from renewables now that it's something that you've followed for 6 years or so? Right. I got to imagine that you're looking at it tangentially, right?
Yeah, I look at it tangentially. I think there's a great role for it, and I think there's a nice growth profile to it. Just similar, like I think about EVs, right? It seems people like to frame debates, it's all or nothing. And,
Well,
you know,
those are those rules of thumb, right?
right?
It's a
Exactly.
lot easier to live that way than to have the nuance in the
Exactly.
conversation.
Like you look at platinum group metals, palladium and platinum, catalysts for catalytic converters, right? Well, the PGMs, the commodity's been shot, the miners have been shot, the people in the service, the people who recycle it, their stocks have been shot because EVs were going to save the day. And then, well, now EV growth has gone from, I don't know, 50, 60, 70% down to 10%, whatever it might be. Every day you see, it seems you see a new car company or truck company saying they're going to slow down a little. So then, that doesn't mean EVs are not going to be there. They'll be there maybe at a slower pace, and markets will adjust to that. Same thing with wind and solar. I think they serve a really great purpose in certain parts of the world, and I think there will be a reasonable growth rate to it. So, but again, it's all for nothing, it seems that people think. So we haven't gone down that road from an investment standpoint. Our focus is on that portion of it has been uranium, but it often, like, there's three sides to every story, right? Your side, their side, and the truth. And it seems like that's the way with these industries, that there's bulls and bears and the truth lies somewhere in between.
Yeah. The EV thing I think is really interesting because the growth has slowed or even gone negative, but it's like, okay, well, give me a large purchase consumer discretionary funded by debt asset class that
Yeah.
has grown over the last 2 years. Like, you can't find it.
Right. That's a great.
So, how much of this is interest rates versus the I don't know. It's going to be interesting to look back 3-4 years and see what happened.
It is. That's why we've been just sniffing, just trying to explore the PGM side of things. I see a lot of similarities to uranium in a sense, where you've got a market that is, you've got the major producers in PGMs. It's Russia and South Africa. In uranium, you've got Kazakhstan as a major producer, but the Russians, it's one's persona non grata to the west, and South Africa is a very challenged state to produce in. So you've got real price risk all the time in there. You've got a technology where people just assume that the ICE engine is going the way of the dodo bird. And so they just ready, fire, aim, and shoot anything associated with that. Just like you had people thought nuclear technology, nuclear power was going the way of the dodo bird just 6 years ago. And the truth is neither is happening, right? As these EV platforms slow, well, the ICE engines are hanging in there. And so it's just finding that price where there's an economic incentive to produce and the companies can match. So there are similarities there. So from that standpoint, we do sniff around the PGM space.
Yeah. More cyclicals. Did somebody hurt you when you were a child?
Pretty much. I think I'll tell you what, I know the secular stuff I find kind of boring. So, and I think, it's a really good point you bring up though, but I think investing, you've got to do what your personality is, right? And
Yeah.
what I learned early in my career was being a contrarian for the sake of being a contrarian is a way to get your head handed to you, right? It's okay to question things, but you can't just be contrarian. And so there's a lot of things that over the years you look at and you say, you know what, I could see where I might be right, but there's enough evidence showing that I'm not, it's time to move on. And I look for that every day in nuclear and I can't find it.
What would you, if you had parting advice to, let's say, a younger analyst?
Mm-hmm.
I mean, knowing what you know now and stumbling upon this trade when you did,
Yeah.
and not even a trade at this point, like a true
Yeah.
long-term investment, what would you tell people to go out and look for and seek?
I would look for industries that are really down on their luck, I look at my world is commodity and commodity linked equities, but it could apply to any industry where something is down 70, 80, 90%, where you've had a lot of failure. And the longer that's existed, the better the chances is that human element coming in, the recency biases, which permeate all sides of the market. So that's where I would look. And if you're a young analyst, you will have access, if you're working at a fund, you'll have access to the sell side research. I would really try and stay away from that at first because it's going to be biased. And, now I'm not getting into agendas and all that, but if you're an analyst and you're recovering an industry that's been beaten up for 7 years, are you going to be the one that's going to stick your neck out and pound the table to buy it? Probably not. You might be, but that doesn't really happen a lot. And you tend to see them follow. A career preservation, right? And that I get that, but
and Mike, going back to an earlier part in our conversation, if they're talking to the insiders in the industry and the people inside the industry are convinced the industry is dying, you're not going to get a unique view.
100%, Bill, and that's what happens. And so, when early on, when I would start talking to uranium analysts, as I got to know them and started to form my views, I was met with this. Not all, but some of them say, "You're wasting your time. What are you doing?" And so it all comes down to when you're looking at commodity linked type things, it's all fourth grade math. It's supply and demand. None of this stuff is that complicated. Uranium has some enrichment math that you got to try and figure out. It's a little more complicated, but I don't know. You can figure it out. So it's really looking for industries that have been beaten up, where a lot of the companies have disappeared, where there's a negative bias permeating it, and then trying to take a holistic view of supply and demand. And it really just requires spending some time doing it, right? Finding your own sources. Like we went to the WNA and downloaded the PRISM database and looking at all the different reactors, trying to understand. It takes time. And if you're a young analyst, you have to work for a firm that is willing to give you that time, right? I often hear from younger analysts or guys who work for me say they're talking to someone who's looking at uranium and the spot price. This is a good example. Spot price is down a couple of bucks. And my guy will get a call from someone at one of these firms saying, my boss says I got to be missing something. Somebody knows something you don't. It's like, okay, well, that's not true. You might think that, but this isn't oil, right? This isn't looked at. Even that I could make an argument, but that's not the case. But you just have to ignore the noise, and you have to be at a firm that allows you to do that, right? That has longer term capital. If you're in this for a quick trade, it's not the trade, it's not the investment. But it really is. Let your own research guide your numbers and let those numbers guide your conviction. When somebody tells us something about nuclear or uranium that can affect supplier demand, well, I could plug and play it into our model, and I don't care what the narrative is. I understand how the math works, and then we'll go from there. I have to respect the narrative. Like I said earlier, it helps inform maybe how I want to position sometimes, but just do your own work. I worked for a really, really good hedge fund manager many years ago. I won't mention his name here, and one of his rules was never underestimate the laziness of investors. And right, just because you hear it doesn't mean it's so. And so just say, do your own work.
I like it. Well, Mike, I appreciate you coming on the program. I was reticent to dip my toe into uranium because it has bubbled up into my feed a little bit more. And whenever people kind of get on a trade, I get a little bit nervous about it. But I always told myself, if Mike Alkin ever contacts me or anything and wants to come on the show, he's the guy I'm doing it with. Or that guy, John Quakes. John and I have never actually chatted. And I don't know, like I said, when you popped into I don't know if you followed me on Twitter or somehow liked something.
I was going through it because I don't post anything, and I check Twitter every few weeks. And I happened to go in and I saw on my timeline something, you had an interview, and I've seen you do things before, and I've always loved your work. But I noticed in my thing, I didn't follow you. I said, oh, let me follow. So because I don't know how because I lost track of you.
Yeah, man. And then I was like, is this really Mike Alkin?
And then you hit me with the DM saying, is that you? I said, yeah. And then that was that. But yeah, so that's great. I'm glad we connected.
As am I. And I hope, to the extent that this gets the word out on you and your firm, I hope you get some good inbounds, and I hope maybe some more informed calls come in. And I appreciate you teaching my listeners something. Is your podcast still up?
No, I haven't done that since 2019.
Yeah, I didn't know if it was still like in the feed or something.
That's a good question. I don't know.
Yeah, well, people should listen to it. To the extent your content is your resume is loud and clear on this idea, man. I commend you for it.
There's a bunch of stuff on YouTube. We don't have a channel, but I've done interviews and stuff like that.
Well, good deal. How can people get in touch with you?
I think if you go to sachemcove.com, there's a way. I have a business partner, Tim Rottola, who runs that side of the business. I don't go to her website, so I don't know. But I think it's sachemcove.com. Yep.
We'll drop it in the show notes. And again, thanks for your time. It was a pleasure.
Bill, I really enjoyed it. Thanks so much.
All right, Mike. Take care.
Okay. Bye.
Absolutely.